welcome to Property Matters on Dublin South FM. You can contact the show on Twitter, Facebook or LinkedIn at iPropertyRadio, or indeed email the show at hello@iPropertyRadio.com. So your hosts for today are myself, Carol Tallon, and especially for Pensions Awareness Week, we have a guest co-host, Feargal McKenna, Head of Debt Advisory at Beacon Capital. So Feargal, thank you so much for joining me today and being my co-host.
Thanks, Carol. And look, firstly, very pleased to be on the show and to be able to spread the awareness about Pensions Awareness Week. So I'm one of the directors at Beacon Capital. We're a boutique real estate and debt advisory firms. We evaluate real estate transactions and structure them to try and net the best return for the clients. And that service can be anything from site analysis to a pre-purchase stage, to sourcing and structuring capital, to looking at eventual options. We've had a particular focus on social housing in the last couple of years, but debt capital advisory across investment properties on a single or portfolio basis, bridging finance and settlement finance are all part of the services that we provide. Now,
great, and we're going to be touching on a lot of those elements today. So actually talk us through really the people we'll be hearing from today and the topics that we're going to cover from, I suppose, from a pensions perspective.
Sure, yeah. So why am I here? Yeah, well, I guess I'm part of a campaign which is Pensions Awareness Week. And if you weren't aware of Pensions Awareness Week before this show, the campaign is obviously working because you're aware of it now. And it started earlier this week where we had a session on starting your pension journey. And we've different themes that run throughout the week all the way through to Friday with a variety of topics, and one of those being property and pension. Now, ordinarily we'd be in our camper van going around the country and meeting with companies and individuals around pensions and spreading the word. But that's we're more kind of shouting from our rooftop, literally, or from our kitchen now at the moment, with the way things are. And I guess the campaign itself is designed to demystify the world of pensions, put it into some plain English, change the narrative a bit on how pensions are perceived, and just normalise the conversation around pensions and just make it approachable for younger people. And when I say for younger people, I'm talking about the 40s, 50s, 60s. Pensions are not for the grey-haired people or the no-haired people. It is really for younger people to consider. So we were very keen to include one of those topics being pensions and property. And I guess the people that are joining us today are talking about the different aspects of looking at pensions through or property through pensions. And I guess, so why, we ask ourselves, why are we looking at property through pensions? Well, there's a couple of reasons. I think property, like any other asset class, needs to be considered as part of your portfolio. And we tend to talk about portfolio or property as one asset class, but you can access it through a broad spectrum of products, and there's a lot of risk rewards options that are available through that.
Okay, and that can sometimes be overly complex for people. So we're going to try break it down as best we can today. And in fact, this would be a good time to bring in our first guest, who is a friend of the show. So our first guest this week, and is joining us remotely, of course, due to ongoing pandemic restrictions, Aengus Burns, advisory partner at Thornton. Aengus, thank you for being with us today.
Carol, thanks very much for having me.
Well, we're delighted, and I know we had a great response the last time you joined us, indeed, on the radio show and podcast. We had a great response, and actually it was particularly pointed out that it was actually understandable, so that's always a good thing. So listen, you know the agenda today. We absolutely want to not just raise awareness for pensions, but also try to demystify using property as part of your pension vehicle. So I suppose really to get us started, you might just talk to us about your involvement in this.
Yeah, so I'm a partner in Thornton. We're an accountancy firm, but I also head up Thornton Pensioner Trustees. So we set up and administer small self-administered pensions for often for property investors.
Okay, and the last time you were on, you spoke to us about the different the tax efficient property investment, kind of the different structures there. So let's maybe start with something that people would be interested to get the outline of, and that's structuring kind of a small self-administered pension scheme.
Yeah, indeed. So, I mean, there are a number of ways of approaching property. It's that the pension structure has come in more and more into the fore in terms of being popular, and that's really down to the taxation of pension. So, you're in a situation where you have income into your pension that is untaxed, gains in your pension that is untaxed, and from a property perspective, that's very, very attractive.
Okay, and Feargal, given that Pensions Awareness Week started yesterday on Monday, so for anybody listening live today on Tuesday, then obviously Pensions Awareness Week started yesterday and it will run for the entire week. For anybody listening on the podcast, you can indeed catch up on any of the pensions events, and there's a watch back and listen back facility for a number of those events. But so as of today, for the event that happened yesterday, Feargal, you might just tell us, in terms of the self-administered pension scheme there that Aengus was referring to, what are the questions that tended to come up yesterday and indeed on an ongoing basis?
Yeah, thanks, Carol. So, I mean, yesterday was all around starting your pension journey, and I guess what we were trying to do was try and capture people that are. It's really not an age demographic. It's more a state of mind. So, whether you're in your 30s, 40s, 50s, or 60s, unless you get yourself into that mindset of starting your pension. And some people do it earlier and some do it later. It's very difficult. You have to get into that mindset and make some sort of start on it. And I guess anecdotally, we would have a lot of people coming into us that have gone on the investment journey into property, and they're realizing kind of late in the stage that there were other options that they had they thought about that, or had they the information in front of them at an earlier stage. So from, the person that sits in front of me asking, Feargal, I want to buy a property and I need some debt for it. Can you help me get it? And we look at their situation and realize that when you look at their assets, their personal assets, it has too many properties that are in their personal name, and you look at their pension side of their balance sheet, and there's a zero against it. And when you explore that with them, their response is that, well, we didn't realize that there was another option for us. And I think it's well documented the efficiencies from a tax perspective in investing in property through your pension. To other examples where clients have built a lot of their wealth up through a special purpose vehicle, which has been set up, largely as a mandate by the lender, who has a requirement to lend only to special purpose vehicles. But the problem is that, late in the stage when that wealth is built, extracting that value from the property can be challenging. So we're not saying that everybody should be rushing out there and investing directly in property through their pension. But what we're trying to do is create an awareness for those people that have decided it's what they want to do, and giving them the options to do it. And you need a couple of extra people at the table when you're doing that. It's a revenue requirement. And Aengus and his team are one of the options there, and one of the people that you absolutely need at the table.
Okay, so Aengus, you can come in here now and maybe explain that. One of the things Feargal mentioned there that struck me, people maybe who go down this track and then realise that actually there were other alternatives, and maybe ones that would have been better suited available to them. So let's maybe, because it is Pensions Awareness Week, and we know that we are obviously hoping to reach out to people who are just at the start of this journey. So maybe let's take them through the process of figuring out what options are available before they get started.
Yeah, I mean, generally we'd look at three options for the property investor. Feargal has mentioned companies, corporates are quite popular. Why is that? Well, corporation tax is a is a lower charge than income tax. There is a close company surcharge on rental income, but generally you'll end up around 40% taxation in a company versus up to 55% tax personally. There is, of course, the challenge of getting funds out of a company later on, and of course there's another income tax charge for that. But the company tends to be popular. Investing property personally, I suppose that the challenges are quite significant in that we know that income tax now is north of 50%. So in order to, I suppose, build the initial deposit, if you like, to buy property, you're working at less than what the revenue is getting. So, if you're able to save up €100,000, really that could be over €200,000 in remuneration, salary, etc. from your employment. Okay, so very difficult to build the initial deposit, let's say, to get going with property. And, we know how tight the banks are at the moment in terms of investing in residential property. So very difficult to get the level of debt to be able to embark on the property investing journey.
What would be, sorry to interrupt you there, but just I suppose to clarify there, and I know that this is a bit of a movable feast, but today, what would be the likely loan to value for somebody starting out?
Well, I can tell you that the pillar banks are really not interested in lending on residential investment property, particularly at lower levels. So you have some niche banks in the space. ICS mortgages are quite active. They say they will lend up to 70% personally. But you have to remember that they're looking at the headroom from rental income on the property also, and what's available there to service the debt. Now, you're into the second scenario then of taxation. Having bought a property, you now have taxation on your rental income, again at those elevated 50% plus levels. And of course, that's allowing way less headroom to service debt. So you have a bit of a double whammy there, purchasing personally.
Okay, you had mentioned at the start there that there are three options. The corporate or personal. What's the third option?
Well, the third option is through the pension, and essentially those double whammies of the initial freeing up cash from your employment, and secondly receiving income that is not taxed are effectively avoided through the pension. So what we're talking about is from your employment, whether you're an SME owner, a self-employed contractor, whether you're working for a larger company, you can have that employer pay monies due to you directly into your pension. And that might have been monies that could have been due to you by some kind of a discretionary bonus or just monies in general due to you. Now, there's no benefit in kind on those monies paid into your pension. And what that means is the entirety of the monies due to you can be paid without tax into your. Let's say you were due €20,000. If you took that out of salary, you might get €9,000 in your back pocket, but this way the full €20,000 goes into the pension trust. So you start with some monies that have not been taxed. You then go off and purchase your property. The income that comes in to the pension in the form of rents is not taxed. In a year or so, the property goes up in value. There's a gain there. You sell that property, maybe to buy another one or to invest in some other asset class. There's no capital gains tax. So you can see that over time, having started with over twice the amount of money because you didn't have that initial tax hit, and then investing in something like property where the yields can be, high single digits, even low double digit returns, over time, without the taxation, you can really build that pension nest egg, let's say, or, to avoid the word pension, you can really just build your personal wealth in a pension type vehicle.
Okay, as you're saying that, it occurs to me, somebody who is absolutely not a pensions expert, that seems almost obvious, and that's the way to do it. So now I'm wondering, why would business owners opt not to do this? Why would they opt to become landlords in a personal capacity, or even through, a corporate rate?
Well, we are seeing that landlords are embracing the pension model. Where they're not, it might be that number one, there's an education issue that they haven't come across the pension structure. Number two, just buying personally might be something they're more comfortable, more au fait with, and really they haven't looked at the taxation. Although I am inundated with calls at the moment with the Form 11 income tax season, income tax returns coming up next month, with people looking at their Case 5 rental income bill, and they're in absolute shock at the size of it. So, really it takes a bit of a wake-up moment on the taxation. Some investors might not be earning or in employment anymore, and they might have come into monies through an inheritance, so they might already have after-tax monies, and they might not have significant income. So in that case, having a rental property where the initial monies, the tax you've already paid, and then just receiving a modest income from the property might not be taxed at the higher level. That might not necessarily make sense to use the pension in that kind of scenario. But certainly we find people of the age bracket, 30s, 40s, 50s, into the 60s. They really see the benefit of the tax-free compounding of growth over time in the pension.
Okay, Feargal, I'll let you come in there because you will know the mechanics of this, advising people on a daily basis. So I'll let you come in and ask Aengus any questions that you or your clients may have on that. Hello, Feargal. Oh, I'm sorry. I think we might have lost Feargal there for the moment. So Aengus, so I have one question based on that. So obviously you've made it very clear that the benefit of investing in property through a pension is that you're using money that hasn't been taxed, the income generated isn't taxed, and any gains made is not taxed. But you mentioned there that, say, if somebody has inherited money or come into a lump sum in however they've done this, as other than working as an income, does it make sense to invest those kind of lump sums into a property through your pension?
Well, it can be quite difficult to do that, and the number of the issue here is that pensions are associated with employment. Okay, so that the reason why government and the revenue commissioners have allowed us such a wonderful tax break, which is what a pension is that it must be linked to employment. So the idea here is that you contribute from your employer into a pension over the years. Now, what you do with your pension in terms of what you invest is, in a self-administered scenario, really up to you, because you can invest across a wide swathe of unregulated investments, and property is one of those. Okay, the other form of pension, which is way more common, is your traditional life and pension type structure, where the self-administered option isn't for everyone. I think most people would prefer to just work diligently, contribute every month into the pension, and safe in the knowledge that those monies are being managed in regulated funds that are quite safe. And I suppose maybe it's just not their thing to be more hands-on with the pension. However, we see that there's a certain cohort of individuals who want to be more hands-on with their pension investments, many of whom like property as an asset class, and they believe and we see that they get returns that are significantly above your traditional pension returns. There's a bit of kind of a coming together of a number of beneficial issues in the market at the moment, and And while we might see it as a negative, that there is an enormous exodus of landlords from the residential landlord market.
Absolutely, yeah. It's something that has been well documented, and we've discussed it many times over the past 2 years on the show.
Now we are seeing the likes of these enormous American private equity funds investing, and they get a lot of space in the newspapers, but they're a very small part of the market. Circa 10% of the overall residential landlord market is taken up by these large US funds. The vast majority of landlords are ordinary folk around Ireland, but they are exiting the market in droves, primarily because of the lack of credit and the lack of taxation, or the
unfairness, the unfairness of taxation when you compare it to the likes of some of the PRS bodies.
But that indeed, and for the middle class investor, that's very unfair. The PRS investors have very little tax to pay, and the middle class investor is being hammered. But that negative is turned into a positive for investors who are able to invest in more tax efficient structures like a pension, because what is happening is the values of residential investment property. Now, I'm not talking about your own owner-occupied property. I'm talking about investment property, which is quite a different type of product in different areas and geared towards different demand. But the value of investment properties is quite suppressed as a result of the exodus of investors. So what we're seeing is quite significantly elevated yields in investment property. It's not unusual to have a net yield of around 8% for property, for apartments after management charges in much of the country. Much of the country's product is priced well below its replacement value, so well below the actual cost of building those apartments or houses. Why is that happening? Well, it's happening because of suppressed demand by your usual landlords, and therefore presents the opportunity for investors who are maybe more professional in their approach, are using a tax efficient structure to enter the market and avail of those enhanced returns.
Yeah, absolutely. Aengus, thank you so much for breaking that down in a way that does make it more accessible for people like me who aren't experts in the pension structures that are available and the different options that are available. So thank you so much, Tim. It seems like a timely conversation to be having in the marketplace at the moment. That was Aengus Burns, advisory partner at Grant Thornton. Thank you for joining us, Aengus. We need to take a quick break now. Stay tuned after the break. Feargal and I will be joined by Rafe Benson, co-founder and head of financial advice at Moneycube. Stay tuned.
93.9 Dublin South FM.
Welcome back to Property Matters on Dublin South FM. So we're back on the line with Feargal McKenna, co-hosting, and myself, Carol Tallon. As mentioned before the break, we're now joined on the line by Rafe Benson, co-founder and head of financial advice at Moneycube. So Rafe, thank you for joining us.
Hi Carol, good to be with you.
Great.
Rafe, look, it's been a busy week for you so far. Maybe you could tell us a bit about what you've been up to at Pensions Awareness Week. And also, we've just heard from Aengus Burns over at Grant Thornton. And I guess one of the things that Pensions Awareness Week is trying to do is explore the options for people to invest in property directly. So you might kind of talk us through a bit about what you're doing in that field.
Yeah, definitely. So I guess Pensions Awareness Week is an initiative we started really to, as the name says on the tin, raise awareness about pensions. For most people, their pension is the biggest single pot of money that they can stick their name on. And yet it's always felt kind of like at one remove from a lot of Irish people don't feel ownership over their pension. So we're really on a mission to just help them create that sense of ownership, remind them that it's their money, that it's important, and that they have a right to kind of ask questions about it, control it themselves, and really take charge of it. Yep. So I guess normally this time of year we would be in our little VW camper van, which is most people's vision of an idyllic retirement, the surfboard on the roof and heading down to hit some waves on the West Coast or something. But talking to you here today in central Dublin, that's probably the least welcome message you could be bringing. The less spreading coming from Dublin, I think, the better for most people. So, so we've gone digital this year, effectively, with Pensions Awareness Week. And there's a couple of bits to that. So we've got a series of webcasts. We've got one every day at lunchtime on a different topic. So if you're listening on the radio, that's tomorrow, Wednesday, all about property and pensions. So we'll be covering some more of this stuff with some of our guests. And also there's a link on the Pensions Awareness Week.ie website to listen if you're picking this up over the podcast.
And there's a lot of people listening here who are in different circumstances. They're self-employed, they're employees. Is the message for everybody?
I guess what we'd say is, there's almost always something you can do to improve your pension position. Now that might be putting more money in. It might be driving down the cost. It might be optimizing the investments that are in your pension. And I think that's particularly relevant when it comes to property-based pensions. But, the key thing is to remember that it's yours, throw your arms around it and start making it work for you.
And why the focus on property then for one of the days, do you think, Rafe?
Great question. I suppose, look, the bottom line is people in Ireland love investing in property, right? In general, people's eyes start to glaze over a little bit when you mention pensions, but in fact, the way things are going, it's becoming the case that, almost like increasingly we see that as the most sensible route to owning buy-to-let property for, if you like, the individual investor. As the Irish buy-to-let market is becoming more professionalised and big corporates enter the arena and so forth.
Yeah, actually, sorry, that's a great about the sector becoming more professionalized, because earlier in the show Aengus spoke about the whole value of buying a property through your pension is that you're using money that hasn't been taxed, the income is not taxed, the gain is not taxed, and and that's something that makes sense. But I think you actually really hit the nail on the head. For a lot of people, they just don't feel ownership over their pension funds. They're doing it almost as something that they know is a responsible thing to do, but maybe they don't have that ownership. And I love that when you say, remember that money is yours and throw your arms around it. I think that's a really good way to get people to take on board that actually this is their money. And not only do they have a responsibility to themselves to look at this and take it, but that actually it can be made accessible. But because you mentioned there about that the industry is becoming more professionalized, the rental sector, we can talk about sourcing property, the right property, setting it up, getting your tenant in. But where are people maybe who aren't experts in property? How do they navigate the risks in terms of things like the right tenant, good tenants, ones that continuously pay their rent, or we're looking at a scenario over the last number of months where there was there was a rollover of rent and then a moratorium on evictions. And, it's become a very unpopular time to be a landlord. So how do people navigate that and the risks?
Yeah, I mean, that's a great question. And it's no different when it's your pension, if your property is held within there. Like typically, the people we work with who have invested in property through their pension, are just as hands-on in managing that asset as they would be if it was held directly in their name, And you're right, Carol, like those problems don't go away. I think one of the things that maybe you're going to be discussing later in the show is around some of the protections that can come through the social housing leases. And, there certainly are people who've done that very successfully. You take a lot of the headaches away in return for clearly an element of discount on rent. But, you're de-risking your investment at the same time as you sacrifice that return, and there's value in that. There's value in, not missing out on gaps between tenancies, risk of non-payment and so forth. So, we would definitely say yes, you may be putting your investment property into a tax efficient structure. That doesn't mean that you don't still need to manage the typical risks around holding rental property. And particularly, it might, like, by definition, a pension is a long-term investment, so it fits very well with property in that way. But that's where the social housing, for example, becomes quite compelling. Because it's not necessarily about knocking the lights out on the return. It's about consistent risk-adjusted returns.
And you talked about risk there, Rafe, and I think that's, one of the benefits of looking at a property investment through your pension is that you almost have to take a step back, because under revenue rules, you have to engage with the advisor, and the advisor is normally the first person that you'd speak to going through this process. Can you kind of maybe explain then, when you're looking at assessing the risk for a client, the things that you might consider as an advisor? Because again, a lot of the people who are probably listening here have an involvement in property through their own personal careers. So, do you take that into consideration as you're advising them to invest in property through their pensions? Is that a good thing, or is that something that they should kind of really consider from an overexposure point of view?
I suppose, one of the great things about when someone has decided they want to use their pension to invest in property is that they are, by definition, taking charge of their own money, and, we're an advisory business, so there's a lot of value in that. But equally, nobody cares more about your money than you do. So, like, what you don't want to take away by stepping in as an advisor is the fact that someone who's making this investment is going to watch it themselves, is going to probably understand it better than anyone. And I think, as we've said, pensions can be a very dry topic. So, if somebody much better to have an engaged investor looking after their assets rather than, the theoretically perfect portfolio, which then nobody pays attention to, So, like, I would say, as a business, we try very hard not to take away that spark of enthusiasm and so on, Having said that, it is definitely the case that a lot of pension pots in Ireland, which do hold property in them, have obviously a heavy exposure to property on a little island on the west of Europe, which has some very specific risks attached to it. And then typically, the other big chunk of assets in that pot will be the cash coming off the asset itself, so the rental cash flow, and potentially new contributions into the pension. So the bit that we kind of, as I say, you're sitting on the same side of the table as the investor here, really. But what we try and work out is what's an appropriate balance between cash, property, and other assets within your pension. And then you might get into a conversation about, should some of this be in the stock market? Should it be in a portfolio of bonds, gold, what have you? So that's the conversation we have.
Okay. So assuming then somebody's decided that they want to invest in property through their pension, there's some additional kind of restrictions or things to think about?
Yeah, well, there are a couple of ways to do it, but I suppose the most common way people would do it is through a self-administered scheme, right? So the scenario is typically somebody senior in a company or who can control a company. You might get a consultant who's incorporated their business as a company, that kind of thing, and is in a position to put in quite substantial quantities of cash into a pension, right? So there, it's worth touching on in a moment or two, maybe, but there is a certain amount below which it becomes inefficient to do this. But typically there'll be a company involved, and we'll set up what's called a self-administered pension. Really, that's no more than a company pension that you can control yourself. But that's what they'll be doing. And, once the money goes in, it's a question of allocation. How are you going to finance that property purchase? Are you going to raise mortgage debt against it, and so forth?
And what are the things that people should think? Should they come with a property in mind? Should they try and set that scheme up first? What are the sequence of things to kind of play out?
Yeah, I guess on the whole, people start with a property in mind, right? So the exam question for people like us is, how do I set this up in an efficient way from a tax perspective that's going to deliver me, increase my wealth over the long term without sacrificing control, and it's going to do it in an appropriate kind of risk-adjusted way for me, right? So not just total exposure to property, for example, or and what have you. So I would say typically people have a property in mind, and that's what kind of prompts. There's a certain amount of effort to put a self-administered pension scheme in place that you wouldn't do if you were just buying kind of liquid assets like exchange traded funds or shares in companies and so on. So I would say yes, but it is possible to go the other way, right? So you could form the vehicle, if you like. So form the investment vehicle being your pension, and you could invest it in assets that you can liquidate very quickly once you've found the appropriate property. And we also do that, and then our job would be more about making sure that the fund was building up appropriately. There was enough liquidity at the right time that you can, cash in that investment and make it available for ploughing into property.
Very good.
So going
very good.
ways.
Thanks, Rafe. And it might be a premature question to ask, but has COVID-19 changed this conversation at all?
Well, it has, and it is. I'm sure, anyone listening to this show will have heard all your coverage on the impact in terms of valuations, uncertainty in the market in general. And there's a good bit of that to play out, isn't there? I can't believe that everyone in Dublin is going to move to Wicklow, but for the short term, that's probably the direction of flow, So, there are kind of market changes, and then I suppose then that reflects back into terms of the overall risk associated with people's portfolios.
Yeah, absolutely. Absolutely. And look, I genuinely appreciate that it is a premature question to ask. And, obviously there were extraordinary measures taken to protect tenants during this time, but they are measures that were important. They were brought in, speedily, which was appropriate. However, they would be absolutely unsustainable in the long term in terms of an investment property market. So again, premature conversation, but it would be naive for us to think that there aren't going to be some long-term impacts for this. But again, maybe that's something that we'll be discussing over the next number of months. But for now, thank you so much for joining us, Rafe. That was Rafe Benson, co-founder and head of financial advice at Moneycube. So we'll take another quick break, and coming up, we'll be speaking with Eugene Davy, principal at Primera Capital. Stay tuned.
93.9 Dublin South FM.
And welcome back to Property Matters on Dublin South FM. So we're back on the line with my co-host for today, Feargal McKenna, and myself, Carol Tallon. As mentioned before the break, we're going to be joined on the line now by Eugene Davy, principal at Primera Capital.
Eugene, hi. We've been talking with Aengus Burns over Grant Thornton and Rafe Benson at Moneycube.ie about pensions and property. And as you know, it coincides with Pensions Awareness Week.ie, which has a focus on property and pensions. And I guess there's a new asset class that lends itself quite well to pensions, and one that we're heavily involved in ourselves around social housing. Maybe could you kind of talk about what's happening from your perspective, what you're seeing in that market, and why it lends itself quite well to the conversation around pensions?
Good morning, Carol and Feargal, and thanks a lot for having me on. I certainly would be delighted to. Firstly, it's probably just important to say what social housing is. There's a lot of talk about it. It's a fairly broad sector. It can include, specialist elderly care facilities. It can include emergency accommodation, but, primarily it consists of people on relatively low and increasingly nowadays middle income salaries who've been priced out of the private rental market and can't afford to purchase a home. According to the latest, government figures from last year, there were about just under 70,000 people on the social housing waiting list in Ireland. And 27% of those people have been on the waiting list, for over 7 years. With COVID-19, it's likely that social housing waiting lists are likely to increase. It's also, it's also worth emphasising, that many of our frontline workers who are performing, such a good job during COVID are in need of social housing. So, it's important that it's something that we do right, and private investors and can be part of that solution.
Yeah, I think you're right, and it's good to dispel that myth around social housing. It does go from everything from assistance or payment of housing for people with addictions and mental health, all the way through to the housing assistance program at the other end in nursing homes. So yeah, good point.
It's also worth sort of putting in the context in terms of how investment in the Irish residential sector has evolved and expanded over the past decade. During the Celtic Tiger years, the government had a policy of home ownership, and post the financial crash, the government has moved more towards a position of tenure neutrality. And they've looked to increase the amount of private capital being invested in the residential sector. People are increasingly renting for the long term, and over the past decade, a new asset class has emerged. The PRS market, and that, $2.5 billion was invested in that sector over the past, in 2019.
Sure.
Social housing sector is a new sector, and it's going to grow hugely. And it's worth sort of putting it again just in the context of what's happening internationally. Throughout the UK and Europe, they have well developed social housing markets funded very often by private capital. Traditionally, social housing in Ireland was fully funded by the government. Houses were built by local authorities or by approved housing bodies. Following on from the financial crash, the government didn't have any money. They had to cut funding to local authorities, which led to a significant decline in new social housing stock. So, faced with a lack of funding, the government just tried to attract private capital to the sector. They introduced in 2010 the first social housing lease, which enabled local authorities entered into leases of between 10 and 25 years with individuals in the private sector. So in return for a private individual providing a house to a local authority, they could sign up for a lease between 10 and 25 years. They're offered between 80 and 85% of the market rent, 80% market rent for houses, 85% for apartments. And the rents increase every 3 years in line with inflation.
Yeah.
Since then, the government has tried to introduce further features to the market. They've introduced a thing called an enhanced lease, which is trying to attract institutional investors. And it's likely that over the years ahead, that that the government will make further efforts to introduce private capital to the sector. One of the key things that's worth, why did the government do it, is that these social housing leases are classified as off-balance sheet financing, which makes it attractive for the government from a financing perspective, because they don't have to bear the capital cost.
Yeah. Sorry, like when you talk about private capital there, we are talking about, the general person out there who wants to get exposure to this has the ability to do that. Isn't that right, Eugene?
Yeah, absolutely. Absolutely. The standard housing lease, which we're working with, investors to acquire, their own 1-2 bedroom apartment, a 3-bedroom house. If you have, 300,000 of capital, or 400,000, 500,000, depending on what unit size you're looking to buy, you're able to buy that either directly or through your pension, which we believe is more efficient.
Yeah.
It's very suitable for a pension product. It offers long-term secure income. There's less volatility associated with social housing investment compared with other real estate asset classes. They offer a very attractive net initial yield. You can get greater than 5%.
Sure.
You know, it's a long-term secure income stream. It's important to emphasize while there's quite a bit of work involved in, you know, in sourcing the property, you know, fitting it out, making sure it meets the local authority standards, and putting the lease in place. You know, once that's done, the local authority is responsible for all maintenance. You know, there's no arrears, there's no bad debts, there's no voids. You effectively have 25 years secure income.
So it's great for a pension product, I guess, is what you're trying to say there. There's good counterparty risk. It's long term, and there's an element after you get through the first hurdle of it being a passive investment. Although I guess you have some control over the investment itself.
Yeah, absolutely. I mean, you're absolutely. So, you know, it's ideally suited, and it's worth sort of pointing out in terms of, you know, why the attractions of the social housing lease versus maybe the traditional sort of buy-to-let investment. You know, the people will be maybe more familiar with.
Yeah,
you know, buy-to-let investors are sort of, have been exiting the market over the last few years.
Yep.
I think I read something from Sherry Fitzgerald the other week, you know, saying that, you know, 32% of all investors in the first half of all vendors in the first half of this year were investors, and only 12% of investors were buying. So investors are exiting the market. 12,000 private properties have exited the market over the last 2 years. Because it's unattractive from a tax perspective, you know, with marginal rate tax, CGT, and investment gains, the increased regulation of the sector, but also, you know, the increasing regulation, the hassle of dealing with repairs and maintenance, voids, rent arrears. When you contrast that with the social housing model, you're signing up to a long-term lease, and once you have the lease in place, you don't have to worry about tenants leaving the property, on an annual basis, dealing with hassle, antisocial behaviour, all that's taken care of.
Yeah. Great. Eugene, thank you so much for that. Feargal, I'm going to go back to you because you're in an advisory capacity, because one of the things I've noticed outside of doing this through a pension, but over the past kind of decade and a half, the take up in terms of the long-term leasing, and we see it again with, you know, the other similar products, state products like the repair and leasing scheme, the take up is traditionally quite low. So can you explain, like Eugene has explained the benefits of it, but perhaps you could explain when you're dealing with potential consumers of these and users of these initiatives, what is the take up like?
Yeah, I think look, there's definitely a swell of people who are getting more of an interest in this market as they learn more about it and learn the benefits of it. So they may just have an interest in investing in property, and then look at the options of a buy-to-let property versus that. To a private person versus social. And a lot of the myths that are out there around social housing are starting to fade away as people realize that, you know, the social housing is such a broad category of an asset class. And there are some fantastic returns that can be made when you look at the risk return on some of the transactions that are available. So I would say that the take up has been low, but I get there's a number of reasons. It's education, it's availability of capital, it's not knowing where to go, so I think you need a number of people at the table when you're looking at these transactions. And if you're looking at outside of your pension, you still need a number of professional advisors to assist you along the way if you want that to be a successful transaction. If you want to do it through your pension, you need a couple of more, and we've spoken to two of them earlier on, being you know, a trustee and a financial advisor. So I think the momentum's coming here, and it is happening, and it's one of the reasons why Pensions Awareness Week has a focus on property. We have a full session talking about the various different categories and how to access that. And one of the reasons why the spotlight is there is because we've had more people into us asking about how they get access to these type of products through their pension or not.
Okay, that's interesting. So you actually have people raising this as an option, as in I want to invest in property through my pension and I want it to be social housing.
Oh, absolutely. Yeah. We would have people come to us at various stages in the process. They might be coming to us with a vacant property and looking for funding on that. They might be coming to us with an eye on a site and looking for advice on what they should do in terms of developing that site. What's the best mix? We assist them with speaking with the various different housing authorities or councils and understanding what are the better options there, all the way through to setting that transaction up and structuring it in a way that nets the promoter the best return, and then looking at the exit options at the end of the day, and that can be an exit for sale to one of the housing authorities or a council, or it can be to an institutional buyer. So, by all means, there's I would say that the majority of inquiries that we have at the moment are actually related to social housing.
Okay, that's really interesting. And Eugene, you started by I suppose positioning social housing very well by explaining how it has evolved. And outside of the pensions conversation, I would say that a huge driver of that has been the approved housing bodies in Ireland. They've really emerged since the crash over the past decade or a decade and a half. They've really emerged in a very organised way, leveraging state resources against international low-cost funding, long-term low-cost funding, to be able to very professionally and compassionately deal with the housing lists of local authorities nationwide. So I would say that, approved housing bodies have been so instrumental in this. So where does the individual investor in social housing fit when we see that the approved housing bodies have done a tremendous job over the past decade or decade and a half and are growing? They're growing at an important rate, but a great rate. So where does that leave private investors who want to buy social housing through the pension? Is that taking them maybe outside of the very well serviced areas and outside of the urban areas into maybe market towns?
Well, in terms of, I think that, the social housing sector is such a big sector. There is room for, approved housing bodies. Is there a long-term source of capital for the sector? We need the approved housing bodies. We need local authorities, and there's also a role and a niche, for private investors. But the approved housing bodies are great at, getting government funding and third-party debt financing, to deliver large schemes of 100, 200 units. That's what we need. They're doing that very successfully over the last number of years. Obviously private investors operate at a much smaller scale, and they can sit alongside approved housing bodies on the basis that they're it's an investor buying one or possibly two units and leasing them to the local authority, so they're not in competition to each other. We view them as complementary and all part of the solution that's required for the housing crisis.
Yeah, that's a great way actually to articulate it. There is no overall solution, and that every element, it all forms part of an overall and holistic solution. So I think that's a very good way to sum it up. Thank you for joining us today, Eugene. That was Eugene Davy, Principal at Primera Capital. So that's it from us today, and thank you for listening in to Property Matters on Dublin South FM for our Pensions Awareness Week special. You can get in touch with the show on social media at iProperty Radio or emailing hello@iPropertyRadio.com. So also my thanks to Peter Rice on sound, show producer Katie Tallon of Hear Me Roar Media, and special thanks to my guest co-host for the show this week, Feargal McKenna, Head of Debt Advisory, Beacon Capital. We're back at the same time next week. From myself, Carol Tallon, and all the team here, stay safe.